Today, we're diving deep into the explosive artificial intelligence industry to figure out if we're on the verge of a brand new era or if we're just repeating one of the biggest financial crashes in history. Look, we're in a market environment right now that feels incredibly familiar. And understanding the mechanics behind this boom could literally be the difference between losing everything and protecting your wealth.
To really get this, I want you to imagine for a second that you started investing back in 1998. The whole world was going absolutely mad for the internet. But fast forward to the year 2000, and after years of that explosive hype, the NASDAQ plummeted nearly 80%. Millions of dollars were just wiped out for everyday investors who honestly thought the boom was going to last forever. And here's where it gets spooky. Notice how the blind investments back then into absolutely anything ending in .com perfectly mirror the massive waves of capital flowing into any company with AI in its name today. In the late 90s, companies saw their valuations soar based on fancy names alone, and right now, we're seeing a terrifying amount of that exact same energy.
People keep calling AI a once-in-a-lifetime opportunity. And hey, maybe they're right. But history doesn't usually repeat, it rhymes. Every single generation thinks they've unlocked some brand new paradigm. But assuming this time is different is a highly dangerous game. It always pays to be cautious when the hype hits a fever pitch.
Okay, let's jump into part 1, the AI spending arms race. Right now, the fate of the entire stock market is resting really heavily on the shoulders of the Magnificent Seven tech giants. These companies, we're talking Microsoft, Alphabet, Meta, they now make up a staggering 36% of the entire S&P 500 index. So whether you realize it or not, if you have money in the market, your future returns are heavily dependent on how this AI arms race plays out.
And make no mistake, these giants are aggressively locking horns. We're looking at Meta spending $60 billion just on data centers. Google is dropping $75 billion to rebuild their infrastructure. And Microsoft, they're funding an incredible $80 billion into supercomputers and startups. They're burning through cash at this rate because they believe the alternative, losing the AI race, is basically corporate death.
When you factor in all the major players, including Amazon and Apple, they are expected to spend a combined $330 billion in just one single year. To put that sheer volume of cash into perspective for a second, that's more than the entire gross domestic product of whole nations like Finland or Portugal. It's this unbelievable level of spending that's keeping the tech economy so hot right now.
But the scale of this gold rush gets even wilder. We aren't just talking about a short-term blip. Global spending on power and resources alone, just to fuel these massive AI data centers, is projected to top $3 trillion a year by the end of the decade. The physical demands of this technology are absolutely unprecedented. Which brings us to part 2, the circular revenue machine.
Let's break down how this builds into a really questionable cycle. It basically works like this. A major tech company funds an AI startup. That startup then turns around and uses those exact funds to buy expensive server time back from that same tech giant. The giant then takes that money, goes out and buys chips from hardware makers, and guess what? The hardware makers then invest right back into the AI startups. It's essentially a circular revenue machine. It is quite literally like paying your friend $1,000 to dig a hole in the woods, and then them paying you $1,000 to fill it right back in. At the end of the day, you both magically get to record $1,000 in revenue on your balance sheets, and that pushes stock prices up, even though no real external economic value is actually created. To simplify this whole messy web, think about it like this. The chip makers are the ones selling the incredibly expensive shovels. The data centers are providing the land to dig on. And the AI startups, they're the ones furiously digging the quarry. They're all artificially helping each other out to lure investors into the mines. But the truth is, nobody has actually struck pure, self-sustaining profit gold yet. So, the crucial takeaway here is this massive disconnect. Top AI firms are currently valued at an astonishing $500 billion, yet they have comparatively tiny actual revenues, hovering around $12 billion. They're losing money every single month, desperately hoping that corporations become so dependent on AI that they can eventually just hike up prices and finally cash in.
Now, let's move on to part 3, hitting the data wall.
For now, the stock market is banking heavily on AI, just continuing this breakneck speed of exponential improvement forever. But we are rapidly approaching what experts call the data wall. See, AI models learn by devouring data, books, research, articles, you name it.
But there is a very real impending physical limit to the high-quality training material available on the internet to actually make these models smarter.
This is honestly wild to think about, but by 2027, these AI systems will have devoured practically every single scrap of human-generated content that exists online. It's like climbing a ladder, assuming the rungs go on forever, only to suddenly run out of ladder. If AI can't scale past this wall, progress could just grind to a halt, and that would aggressively pop the bubble of investor expectations.
So, what do we do about it? Part 4, Surviving with Index Funds.
First off, we do have to acknowledge a key difference here. Unlike the late 90s, where companies skyrocketed just for having a .com name with literally zero business model, today's AI companies actually do have real utility. They're fundamentally changing workflows, and they do have a theoretical path to profit. But, and this is a big but, they're still dangerously overvalued right now, and the bubble risk is very, very real.
To protect yourself, the absolute smartest move you can make is setting up automatic, recurring investments into broad, low-cost index funds. You just want this happening quietly in the background every single month. And crucially, you've got to keep yourself entirely out of consumer debt and avoid over-leveraging. You do not want a sudden market shock forcing you to sell your assets at a massive loss.
And here's exactly why this strategy works. By investing in an index fund that tracks the overall market, your portfolio is naturally going to bounce back over time, even if the AI bubble completely pops. Think back to the year 2000. Those who panicked and sold lost everything. But the people who consistently bought into broad index funds throughout the crash, they ended up incredibly wealthy a decade later.
Also, remember that your active income is the actual fuel for growing your wealth. Focusing on increasing your income, whether that's gunning for a promotion or starting a side hustle, gives you something incredibly powerful during a market panic: cash flow. It gives you the readily available dry powder to step up and buy into the stock market when everyone else is running for the exits and shares are practically on sale. Finally, true financial survival requires radical diversification. You cannot bet your entire financial future just on tech stocks. You need to spread your wealth across entirely different asset classes. Think broad stocks, bonds, gold, maybe real estate. This way, if the tech sector takes a massive hit, the rest of your portfolio is there to provide a much-needed safety net. And within those stock portfolios, dividend-paying stocks are incredibly powerful during major downturns. They act as a steady drip of passive income directly into your account, regardless of what the underlying stock prices are doing on any given Tuesday. The whole game is about maintaining consistent cash flow, even when the market is bleeding red. Look, a market crash truly isn't the end of the world if you understand the underlying mechanics and you have a solid, level-headed strategy in place. So I'm going to leave you with this to seriously ponder today. Looking at the state of your own portfolio right now, are you genuinely diversified and ready for history to rhyme? Or are you just crossing your fingers and hoping